Good afternoon. Welcome to Halftime Report. I'm Sonia Shenoy. With me is Mangalam Malu. Things are looking like they're all over the place in the market. If you looked at the headline index now, you would think it's flat, but that has hardly been the case. Through the course of the day, it's been up and down, those jagged edges on your screen. Suffice to say one thing, that this market is a sell-on rally market, something we've been seeing for a while. And of course, there's a lot of data coming through over the next couple of days. There's the CPI data from the US tomorrow. There's the FOMC meet next week. So I think, it's tentative, but more veering towards the downside than the upside.
It's veering towards the downside. It is tentative. And just to add some more spice to the volatility that we're seeing, it's also the weekly options expiry today. That's one. Secondly, oil at near 13-14 week high. We also have rupee, which has hit a fresh record low at 77.8. But all of that and more in just a bit. The important data points that are coming at the bottom of your screen. The net equity inflow in May has been close to around 17,659 crores. That has increased month on month. And as always, every time this data comes by, we are joined by Sumaira, who is our resident expert on all things mutual funds. Sumaira, the equity inflow continues, 17,669, irrespective of the way the market's going.
Yeah, but you know what, for retail investors, I mean, mutual funds is really the only way. And I guess there is some sort of sophistication which is setting in terms of people realizing that, they don't want to catch only the tailwind. So they want to get in when valuations make sense, and which is right now, I guess. So yes, there are issues which are plaguing the mutual fund industry, but, for most part, long-term investors have benefited, and we are seeing that they continue to maintain the faith. So about 17,600 odd crores in terms of equity flows coming in. For debt mutual funds this time around, there is a bit of an outflow, and we are seeing outflow from, money market, low duration, those kind of funds coming through. I think on the longer tenure, things are still a little bit more stable, but definitely money market, money market, ultra short duration, low duration, etc. The money is going out. Other than that, in terms of hybrid and passives, both have seen a good showing this time around. On the hybrid side, there is about 5,000 odd crores of money coming in, and this has tempered down over the last few months. In fact, I think 1 or 2 months ago we saw outflows over here as well. But hybrid is a category that continues to do well, within which, of course, dynamic asset allocation, or the BAF category, balanced advantage, is what continues to be the main driver. For passives, we have seen a slew of initiatives coming in from SEBI as well, and we're about 12,200 odd crores of net inflows into this category coming in, of which ETFs and surprisingly index funds this time continue to do very, very well. So in total, in excess of about 12,000 odd crores. On the AUM for the industry, there has been a bit of a shave off, but I think this is because NAVs might have shrunk given the market move. This is about 37.22 lakh crores, which might be just about under 1 lakh crore lower than last month. We have Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joining in to take us through what these numbers mean on the ground. Hi Sunil, good to see you in. First up, your take. I mean, we had seen a big fall last month. NFOs are still out for the moment. And, net flows are just about inching higher. Could next month be better, or do you think there is still some bit of sentiment which has been dented post the recent issues?
No, actually, I don't see sentiments being dented because, NFOs generally attract a lot of fresh money. And if you're looking at these numbers, in the absence of NFOs, I think augurs well. As far as next month is concerned, I think the SEBI ban ends on June 30. Now, unless SEBI, extends the ban or the issues not get resolved, if NFOs come back next month, should be a bumper month for MS from an inflows perspective, because there's a lot of pent-up demand there. But broadly, I would say these numbers continue to reflect the maturity of the Indian retail investor. They're not panicking in terms of the volatility that's being seen in the markets consequent to what's happening in the rest of the world. And I think that they're sticking to their core thing of looking at equity as the best asset class. Especially fixed income is also in the context of RBI's increasingly rate hikes, and another one around the corner. In market participants expect, medium-term debt funds should experience a little bit of a challenge. So I think that equity remains the best asset class because from a perspective of the alternatives, while fixed deposit rates are gently starting to creep up following the RBI policy, you'll still find a big delta on a post-tax between high single-digit equity returns could handsomely beat post-tax, fixed deposit kind of returns.
Yeah,
so I think that confidence remains with the investor.
You actually preempted my next question, Sunil, because I'm looking at some of the performances of key indices. Year to date, there's been a 9% decline in the mid-cap index. The Nifty itself has been on a 6% decline. At what point do retail investors start to worry? Because on the one hand, while equity markets are seeing a bit of a decline from the top, we're seeing interest rates increase as well. So that would make some of the fixed income products a little more relatively attractive. And then the third factor that comes in is rising expenditure on account of higher inflation. Would that eat into some of the savings baskets, and could that be a bit of a worry going forward?
I don't expect that. See, on the whole, if you look at it, the economic news around India is reasonably healthy. GST collections are rising, capacity utilization is back to long-term average. You're seeing, even the private sector starting to do new capex announcements. You saw that the government also, through RBI, gave a big boost to the real estate sector. So I think that since the news around the economy is reasonably positive, I think that investors don't want to lose sight of the fact. And bear in mind that just about a few, 18 months ago, they had panicked when the COVID crisis hit. And then those who actually redeemed saw that they had lost out on an opportunity. So I think they are wiser, once bitten, twice shy. So they would give a longer rope to look at the equity returns. You are saying year to date. Actually, India market has done much better than other emerging markets on these same returns basis. So I think that there is a maturity level which is increasing. So maybe if, let's say, a 3-year investment return turns very negative, that's when maybe they start to think, oh, did I make the right decision? But as things stand currently, I don't see a sense of panic in the investors stepping in. And to your point on the fixed income that you see as interest rates rise, maybe some amount will go to fixed deposits. But, mutual funds, the interest rate hike generally hurts mutual fund NAVs because of the mark-to-market.
Okay, since you pointed out the interest rate hike, let me take that forward. Sunil, hi, good afternoon. In the debt schemes, right, there's been an outflow this time around of 32,000 crores. Now, a rate hike, as we know, is always bad news for debt mutual fund investors because the NAVs of debt schemes comes down because of perhaps, the inverse relationship between bond yields and prices. Do you think this outflow is something that could continue in the course of the next few months?
To some extent, because I think that most people are now aware that in a rising interest rate, you stick to the shorter end of the curve. The second is on the money market, I wouldn't dig too much into retail investors there. I think it's largely an institutional product. Okay. So institutional products, they take a tactical call, So I wouldn't read the money market outflow as a retail investor pulling off. Retail investors generally tend to stick to low duration, ultra short term. And I think that if you want to capture, I would say that accrual funds and floating rate funds are probably the better option in terms of in a rising interest rate scenario. So I don't think that fresh money coming into debt may see a pause. But to existing people who are in debt generally stick for 3 years because of the taxation.
All right, Sunil, thanks very much for joining in with your thoughts. So that's, how this, or rather the previous month has shaped up. Like Sunil said, in the absence of NFO, still the ban continues, the numbers look quite decent.
Okay, all right, Sumera, thanks a lot for that. So that's the May mutual fund data. Well, as Sumera was saying, there's a TINA factor, right, for Indian investors, especially after the crypto fall that we've seen. There is no other place really to put your money apart from the Indian equity markets. So the domestic flows continue to come in. For now, the market is absolutely flat, but the Sensex and Nifty have drifted into the green. So it's flitting between the red and the green line as we speak. We'll slip into a quick break. On the other side, we'll get you more on the markets. A lot of stock-specific action as well lined up in just moments from now.